All right, let's dive right into this explainer. Today, we're putting Arch Capital Group, ticker ACGL, through the ultimate Buffett-style quantitative teardown. If you've been searching for a company that perfectly bridges the gap between high growth and deep value, you are definitely going to want to pay close attention to the numbers we're unpacking today. We are looking strictly at the hard data extracted from their filings. No fluff, no promotional language, just the absolute financial reality of the business. Now, take a look at this staggering number on the screen, over 1,100%. That is Arch Capital Group's 10-year return. I mean, if you had parked your capital here a decade ago, you'd be sitting on a return that completely crushes broader market averages. It's a true multi-bagger. And seeing a number like this absolutely demands that we ask a fundamental question. Exactly what kind of economic moat allows a company to generate such massive compounding value over the long haul? To figure that out, we're going to run through a classic 4-part value investors checklist. We'll track their historical growth, measure efficiency and returns, audit their margins and health, and finally calculate the true valuation and fair price. So let's jump straight into Section 1, Historical Returns and Growth. This table beautifully illustrates a highly predictable historical engine. Just look at the right side. Arch Capital has maintained consistent double-digit growth over both 3- and 5-year periods across the board: revenue, net income, and earnings per share. Their 5-year revenue compound annual growth rate sits at a very healthy 16.1%. But you know what really jumps out is on the bottom left, an explosive trailing 12-month EPS growth of over 95%. They aren't just growing their top line, they are aggressively expanding the true earnings power for the investor. But hey, as value investors, we have to look at the whole picture, right? Not just the highlights. While the 3-year and 5-year free cash flow growth was undeniably strong, sitting at roughly 12% and 14%, that recent 10% drop in the trailing 12 months is definitely a metric we need to watch. Free cash flow, or owner earnings as Buffett calls it, is the ultimate truth teller in finance. A negative short-term trend here amidst booming EPS suggests working capital shifts or capital expenditures that warrant some close monitoring. Okay, moving on to Section 2, Measuring Efficiency and Returns. Growth is great, but how efficiently is management actually allocating that capital? Before we look at the exact numbers, let's just quickly establish our baseline. To translate this from finance speak, return on equity, or ROE, simply tells us how effectively a company turns the money shareholders have invested into pure profit. It's really the ultimate measure of management's ability to compound your wealth over time. So the crucial point here is this current ROE of nearly 20%. To put that into perspective, in the financial sector, 10 to 12% is generally considered pretty solid. Arch Capital is operating at almost double that. That's a massive indicator of a durable competitive advantage. And even more impressive, this 19.98% sits roughly 13% higher than its trailing 12-month average. Management isn't just maintaining this efficiency, they're actively improving it. Now, when we compare these two efficiency metrics, a really interesting capital allocation dynamic emerges. We see a relatively modest return on invested capital of just over 5%. However, look at that absolutely massive free cash flow yield of almost 18%. This business is generating a tremendous amount of excess cash relative to its valuation. That gives management incredible firepower for either opportunistic buybacks or organic reinvestment. All right, Section 3, Margins and Financial Health. Because remember, a highly profitable business can still collapse if it's drowning in bad debt. And wow, this margin profile is fantastic. For every single dollar of revenue Arch Capital brings in, over 22 cents drops straight to the bottom line as net profit. And this isn't some one-off fluke either. Their trailing 12-month net profit margin matches this exactly, and their 3-year average is actually even higher, at nearly 26%. This proves they have serious pricing power, which is a classic hallmark of a wide economic moat, and ruthless cost control. Looking at the balance sheet, it is incredibly clean. The debt-to-equity ratio is a tiny 0.11. This shows a highly conservative capital structure. What you really want to take away from this data is the trend. It's steadily decreased from a 3-year average of 0.14 down to 0.11 today. Management is systematically de-risking the balance sheet, which is exactly what you want to see before heading into any potential macroeconomic turbulence. Which brings us to Section 4. The grand finale, valuation and fair price. We know it's a growing, healthy business, but based strictly on the math, what is the stock actually worth? Well, at a current share price of $93.32, the pricing multiples are remarkably low. The price to earnings ratio is just 7.17, which is a 16% discount to its own trailing average. But the real star of the show here is the PEG ratio of 0.21. For those who track it, a PEG under 1 is generally considered undervalued. At 0.21, we're looking at a metric that sits roughly 50% below its historical 3-year and 5-year averages. The market is pricing this thing like a shrinking cigar butt, not a double-digit compounder. And that brings us to the legendary concept pioneered by Ben Graham and Warren Buffett, the margin of safety. It is the crucial buffer that protects investors from unforeseen errors in our discounted cash flow models or from sudden economic shocks. You know the rule. You never want to pay fair value. You want to buy a dollar for 50 cents. So let's see how this actually builds out in the discounted cash flow models. Look at how these calculated values reconcile against that $93 current price. Whether you use the free cash flow model yielding $336 or an earnings per share model that shoots all the way up to $620, the intrinsic value completely dwarfs the current market cap. The math points to an extreme disconnect between the stock market's current quote and the company's true owner earnings. And this brilliantly illustrates the bottom line of our explainer today. According to the more conservative free cash flow model, Arch Capital Group is currently trading with a staggering 72% margin of safety. The market is literally giving you over 70 cents of downside protection for every dollar you invest, assuming these historical cash flow trends hold up. The quantitative dashboard we've built today suggests an incredibly undervalued powerhouse with a pristine balance sheet. But as any savvy value investor knows, spreadsheets only reflect the past and the mathematically projected future. You really have to ask yourself, is this economic moat truly durable? Is there a looming shift in the insurance cycle, or some unforeseen qualitative risk hiding just out of view? The numbers scream opportunity, but unlocking that final piece of the puzzle is where your real homework begins. Thanks for joining me on this explainer, and I'll see you in the next one.